In the heart of Latin America, innovation thrives. Startups are shaping the future, and venture capital fuels their growth. But what happens when the next big leap requires more than private funding? Enter the IPO, the initial public offering. An IPO is when a private company offers its shares to the public for the first time. This transition unlocks significant opportunities: access to larger pools of capital, increased visibility, and a stock currency that fuels growth. For Latin America, IPOs are more than a financial milestone. They are a catalyst for economic growth. Public companies attract global investors, inspire confidence in emerging markets, and set the stage for innovation ecosystems to flourish. This journey can be daunting, but that's where HF Capital comes in. We specialize in guiding growth stage tech companies through every step of the IPO process in. Our expertise spans global markets, from Silicon Valley to London. With years of experience, we save founders hundreds of hours and millions of dollars, ensuring a smooth transition to public markets. At HF Capital, we believe in the power of Latin American innovation. Together, we can make IPOs the next big step for your company, fueling growth and transforming the region's innovation ecosystem.
Olá a todos, sejam bem-vindos a este webinar incrível sobre o cenário do capital de risco. Que prazer tê-los aqui conosco. Gostaria de lembrar a todos na plateia que este evento será em inglês. Sean bienvenidos todos a este webinar tan increíble sobre el panorama del capital de riesgo. Qué gusto tenerlos aquí con nosotros y me gustaría recordarles a todos en este evento que será en inglés. Welcome everyone to this incredible webinar. We are so glad to have you here with us. I'd like to remind you all that this event will be in English. So, we are thrilled to have you join us today for this insightful discussion on the evolving venture capital landscape. As we step into 2025, we see new challenges and opportunities arising for funds actively raising capital. With shifting markets dynamics, increased competition, and more selective LPs, understanding key trends is crucial for crafting successful fundraising strategies. Before we dive in, I would like to remind you all that you can comment where you're from and all the possible questions you may have during the presentation in the comment section. So without further ado, let me introduce you to Jonathan Nelson from HF Capital. Jonathan, how are you?
Hello, how are you?
I'm great, thank you.
Welcome, everybody. We're actually thrilled to be having this stream and thrilled to have Peter Walker with us. He has some of the best damn data in the venture capital and startup land. Who are we? I'm Jonathan Nelson, Executive Director at HF Capital, and we are trying to streamline the IPO process. The lack of exits and the lack of IPOs has been something that's been killing the venture industry for a while, and it's been killing startups. And so we are building tools using a bit of AI, using some mobile and our relationships to help streamline that IPO process. And we'll be having some events in Silicon Valley here coming up in a couple of weeks with the London Stock Exchange. But Heloisa, I'll let you introduce Peter and we'll get it going.
Okay, so first of all, before I introduce Peter to you all, I would just like to announce that we are really excited to let you all know that Quantico published their latest report on the VC activity in Latin America. It's called Latin America Venture Capital Report 2025. This report is available at Quantico's website, and it provides valuable context on regional trends, offering a deeper understanding of fundraising dynamics in the Latin American ecosystem. So let's talk a little bit about Peter Walker. So Peter, welcome, right? Thank you so much for joining us. I would love to introduce you all to this keynote speaker. His name is Peter. He leads the insights of Team Carta, where he focused on uncovering key data and narratives within the private capital ecosystem. So welcome, Peter.
Thanks so much for having me. Glad to be here.
So, Peter, in your own words, sir, who are you and what do you do?
Asking the tough questions up front. I love it.
I know.
I'm the head of insights at Carta. If you're not familiar with Carta, we began our life as an equity management platform, meaning we are the cap table provider to close to 50,000 startups now. But on the other side of the business, we've kind of grown beyond cap tables to being the fund administrator, the back office, effectively, for close to, I think, 2,500 or a little bit above venture funds in the US and increasingly also around the world. So the cap tables on one side, the fund managers on the other. You know, you can think of Carta as a real nexus for private capital and venture capital in particular. And my job is awesome. I get to surf on top of all of that wonderful data and report it out in published reports and social and talks like this, just kind of educating the ecosystem on what's going on in the market.
No, absolutely. And I love what you publish on LinkedIn. When I reached out and said, hey, can we actually talk? We have a large community of VCs in Latin America and Brazil, as well as in the United States, but everybody's struggling to raise venture for their next round right now in the VC world. And I was like, do you have any data that could actually cover that? And Peter was like, yeah, I can crush this, which is true. So Peter, I know that you had a prezzo and we'll have kind of a conversational sort of thing. And if you guys in the audience, if you have any questions, feel free to put them in the comments and we can ask them from time to time. At the end, we'll probably have about 15, 20 minutes for questions as well. So Peter, take it away, man.
Exactly. Awesome. So a bit of, throat clearing at the top here. First off, yes, you can totally get these slides if you find them useful. Just email me, peter.walker@carta.com. And the second thing is, as to where this data comes from, again, this is all sourced directly from Carta companies, aggregated and anonymized information. So that's 45,000 startups plus 2,000 or so in this report, venture funds. All of this data, and I should make this a blanket apology up front, only concerns US funds and US companies. We do serve companies and funds across the world, but insofar as the insights are dense enough to really report out on, we're hoping that by the end of this year, we can start doing this for other parts of the world as well. So tease for that. Hopefully that comes off pretty soon. Okay, market context. Jonathan, as you mentioned, has been the most fun time across capital and startup world in particular over the last 3 years. And this is the chart. I mean, this says the whole thing, right? Which is we went kind of wild in 2021, really high valuations, deals being done with very little diligence, a lot of frenzied behavior. And now we're dealing with the hangover from that period. Interest rate changes, a whole macroeconomic shift. We don't need to get into politics, but that's been a whole thing as well. Like, man, it has been a challenging few years for many, many startups. In addition to this downturn, we've had an AI bubble. So we've had the most potentially confusing set of information for founders and investors because on the one hand, it feels like the sky is falling. And on the other, you're reading about rounds in the newspaper that rival or even exceed what was going on in 2021. So it's a bubble within a downturn makes everything more confusing.
Do you have any sense of like what deals have been like, what percentage of VC is going into AI and what percent is going into non-AI companies? Because I don't know very many founders at all that have actually been able to raise decent rounds that aren't AI companies right now.
Yeah, so across, it's different depending on the stage that you're looking at. But for all of Carta companies last year, about 32% of all capital went to AI companies.
Wow.
And you're like, okay, 32, that's a lot, but it's not everything. That's up from like 8% 2 years ago. So it has been a massive change. So that feeling that you're getting, I think, is a feeling that most people also agree with. Is it possible to raise if you're not an AI company? Yes. Is it harder? Way harder. And then you beg the question, what is an AI company? And to that, I say, good luck to you, sir and madam, because it is a very difficult thing to define. And every investor that we talk to has a different definition. So in order to get our data, we did what I think is the simple and dumbest thing, which is we just asked the founders, are you an AI company? And then we did a little bit of work on the back end to like do some verification. But in general, you know, if you're building a foundation model, obviously you're an AI company. But if you're just calling ChatGPT and automating a workflow, does that count? Who knows? Like different, some investors will only invest in you if you are a wrapper. They have a thesis around application layer AI that is just, we don't actually care to deal with the models. We think that that's going to be a boon to everyone else. So it's all over the place. Again, confusing times.
Yeah, no, I hear you.
So if you're looking at that hangover, where has it been worst? The closer you were to IPO, the faster that this fundraising cliff has hit you. But it's not like pre-seed or seed has been immune to the downturn. It's still a downturn no matter what part of venture you've been a part of. So this isn't the case where early stage escaped some pain and late stage felt all of it. It's across the board. And so for any entrepreneurs who may be listening in or fund managers who are advising their entrepreneurs, the typical advice around US venture for a long time was you're going to raise a round every 18 to 24 months. That's that orange sort of section across this timeline. And you can see that over time, the days between a seed and a Series A, or the days between a Series A and Series B, et cetera, they've just keep creeping up. You know, the median, that's the median amount of time. So if you're a founder and you expected to raise your Series B, call it 600 days, 700 days after your Series A, but you ended up having to wait 1,000 days before you fundraised, could you do it? Right? What changes to your business would you have to make? Layoffs come out into play in here, software spend cuts, changing the capital base of the business. It's been really tricky for entrepreneurs of late. My instinct is that a lot of these lines are difficulty fundraising for sure. But some of them are also choosing not to fundraise by early stage founders who are saying, look, maybe I don't need as much capital as I initially thought. That's also a part of this. So again, just back to our broad theme of confusion, it's not as though these lines paint an altogether terrible picture, but it is something founders should be very aware of, that you might need to make that capital that you raised today last a lot longer than you expect.
Are rounds getting bigger, or basically rounds staying the same size?
Rounds are getting bigger, but they're also becoming more barbell. So the middle, you know, it used to be that the median seed round on Carta was something like $2.5 million. Now maybe it's $3 or $3.5 million. But we also see people raising at the very low end and at the very high end. So it's again, I think people have very different conceptions about how much capital they actually need to build the business. We've heard a lot about, I don't know if I love this term, but like seed strapping, you know, raising one venture round and then trying to get as far as you can with that money. We'll see how that works. I think a lot of companies will try that, and then you'll end up seeing them raise a Series A and raise a Series B, and will, you know, kind of become venture backed in the normal way. But I'm sure many will also try a different path.
Yep.
So what have our wonderful venture investors been doing, if not investing into new companies during this downturn? Well, one of the things that they've been doing is supporting their current portfolios. So this is just an illustration of the percentage of all rounds in a given stage that were bridge rounds, meaning led by insiders already on the cap and not a new primary round with outside investment. And you can see those are quite high, historically speaking. So we've heard from some investors that, more than half of their portfolio has come back and said, we need more capital in order to hit the metrics for the next round. So when that happens, unfortunately for founders, it's not as though VCs can continue to invest into all of their original bets. You got to pick and choose. And that has been very tricky conversations for many, many folks. And then that, of course, if you overfund at high valuations, a bunch of companies in 2021, you then have to deal with down rounds in the later years. So many, many companies are coming to the conclusion that, look, we got ahead of our skis in 21. We are not worth what the sticker price says. So we are going to do the hard thing, and we're going to take that down round. We're going to recapitalize the business in some cases. We're going to reissue stock to employees. The good ones do that, at least for new 409A valuations. But all of this is just a picture of turmoil. These are not fun moments for founders, not fun moments for employees when they even know about it, which many times they don't. This is a picture of a lot of difficult conversations across venture.
Jorge in the audience has a question. He says that we knew that COVID was an outlier and it damaged kind of a bunch of startups. Did COVID change everything, or is this a permanent sort of change, or do you think that there was a correction and now it's over and we're kind of getting back to baseline?
Yeah, so Jorge's question is one that I think about a lot, which is, okay, we understand that 2021 was this aberration, but is it something where you go up and then maybe you undershoot, but effectively long-term you're on the same trajectory, or did it really fundamentally change venture? My instinct is it did not fundamentally change venture. However, the consequences from the COVID times have extended far longer than I think people expected. So the problem was, if you overfund a bunch of companies and they have very high valuations, it has so many knock-on effects. One, those companies have difficulty raising the next round, have to do down rounds, et cetera. Two, you have a lot of layoffs at those companies. Three, fund managers, which is the data we'll get into soon, are not realizing liquidity at the same rates from those companies because they cannot continue to grow. Four, IPOs are closed. Five, the cycle of that overfunding births so many different consequences that it's tough to say we're through it. I actually don't think we're through it at all. I think in some ways, we're going to see, again, this tale of two cities where companies born after the boom function in very different ways than companies born before the boom. And those will just kind of diverge in the woods in some ways. So illustration of that, apropos of Jorge's question. So this chart shows you the graduation rate from seed round to A round. So the year on the y-axis there just indicates when did you raise a seed round, and the x-axis is years since that seed round was raised. And the percentage in each of those boxes is just what percent of companies from that cohort have gotten to Series A so far. So focus on that 2-year column. You can see that for many cohorts in the boom times, something like 30, even one time in 2020, 40% of companies were getting from seed to A in 2 years or less. That is speed running venture capital. Now, recently, that's more like 15 to 17% of companies will get from seed to A in 2 years or less. So there's a glut of companies at every single stage, stuck at seed, stuck at A, stuck at B, stuck wherever they were when the downturn started. And so venture capitalists are having to do this difficult dance of, I want to be good partners to the companies I funded in the boom times, but I'm also really interested in companies that are moving faster than them, that are younger, that maybe are in the same industry or replace them effectively in some ways. So that has been another delicate dance that VCs have had to do, of balancing new investment bets versus supporting of the old portfolio. And that, I think, has roiled a bunch of founders who feel as though they are not getting the support that they expected from their VCs, but in some ways it's kind of just a fact of life, sadly. Okay. Funds. So that's the turmoil that's happened in startups. I think we're all pretty familiar with that general picture. Now we're going to dig into how is that impacting fund performance, VC fund performance. So to illustrate the data set a little bit, we took a look at over 2,000 venture funds that use Carta as their fund admin. As you can see from the fund sizes here, the majority of those funds you would classify as emerging managers. We do have funds up to $1 billion on the platform, but for this analysis, the majority are, say, between $25 and $100 million in committed capital. We think, actually, we're almost certain, this is the biggest ever data set for this part of the market ever released. So when you look at Cambridge or Preqin or PitchBook, the data that they have access to is typically talking about large funds by, for the majority of those cases, whereas this is the early part of the market. So just to keep that in mind. So what's changed? The kind of pitch that you had, Jonathan, a couple times on LinkedIn about what we were going to talk about here. Why are LPs continuing to invest into venture funds? This is one illustration of the difficulty within that question. So this is just the median number of LPs in a fund based on when the vintage of that fund was begun. So it peaked in 21. You might have, 50, 60 LPs. Now it's more like 30 or 40 LPs. So what we think is happening is the same thing that happened to the angel investing community, where there were people who became LPs in venture fund for the very first time in 2021. And they're looking at the potential return and they're going, even if I like this as an idea, I just can't, I can't in good conscience commit more capital to this asset class if my liquidity is going to be so low for so long. And I do think, sadly, there was some, how shall I say, miseducation around how long this was going to take. If you're an LP in a venture fund, you are signing up for a 15-year journey, not a 10-year journey, a 15-year journey based on our data. So if you're expecting capital back in 5 years, you're just fundamentally misaligned with the asset class in many cases. Jonathan, I think you're on mute, by the way.
Sorry about that. I've seen a lot of VC decks that say, 7 to 10 years plus 2, where just the scuttlebutt is that it's taken 10 to 15. It's good to hear you say, no, this is a 15-year ride.
Absolutely. 10 years, I think 10 years is a good marker for having a decent sense of where that fund will end up as a full, in terms of fund returns. I think it's actually a pretty good checkpoint, but that is not the date at which you will get those distributions. It's just not going to happen that quickly. If the biggest companies, especially the big winners, stay private longer, we can talk about secondaries and how that impacts things, but it's just not the case that you can expect money back from these funds. So you have to be long-term aligned in this asset class. And I think the misalignment on time is one of the biggest underlying changes for the last 5 years.
Yeah. And so if there's less LPs per fund, does that mean that the check sizes are bigger or are the funds getting smaller?
Great question. Both are happening. We do hear from a lot of emerging managers that perhaps they went out with a soft target of, say, 50, but they're going to run the fund at 40. That kind of tale is very common these days. But a lot of LPs have kept their check size the same. They're just investing into fewer funds in general. So in some ways, you can actually see some of these check sizes rise slightly, but most of that, I think, is a quote unquote flight to quality or just a choosiness amongst LPs. Pablo has a great question from PitchBook here, or about PitchBook data showing most of LPs are focusing their commitments on the top 5 to 10 GPs. Is this the end of emerging LPs? Emerging asset class, really? I would say no. I think I take issue a little bit with that PitchBook chart in that it is absolutely impossible that a sovereign wealth fund writing $100 million checks is going to invest into emerging managers. So that money was not available for emerging managers in the first place, right? And there is a ton of money being committed to venture, probably, if we're being honest, too much money. which skews and distorts economics in venture in some ways. But that money is not, the money that is raised by Sequoia and Andreessen, et cetera, is not available to emerging managers, and it kind of never has been. Now, maybe those same institutions have an emerging manager practice where they write smaller checks, et cetera. So I'm not to say that this is completely immaterial, but I really think that you have to be focused on fund of funds, family offices, high net worth individuals, et cetera, that are going to fund emerging managers. And in that case, I think that there's still willingness to commit. It's just a liquidity question for a lot of these folks. I think sometimes we think of venture LPs as, oh, who cares? They have so much money. Who cares about them? If you have a couple vintages that return nothing, your willingness to invest into the next successive vintage by default goes down. You're just going to question your allocation to the ecosystem. So I think those are big questions and fair ones.
A LinkedIn user says, in terms of data set size, do you have a sense if AngelList's data set is larger than yours, or if your guys is larger than AngelList?
So I read everything AngelList puts out. None of their reports have any fund counts in it, so I have no idea. All of ours do. If they want to put out fund counts, I'd love to read it. I think that they actually put out really cool stuff. But as far as I know, my instinct based on the way that their performance metrics look versus ours is that under 25 is actually not granular enough. It's probably like under 5. So it depends on what you classify as an emerging manager versus like a trial fund, et cetera. But I think they do great work. And I'd love to read more comprehensive reporting.
No, and anecdotally, I know a lot more fund managers that use you guys as opposed to use AngelList. For me, it's like 10-1, maybe 10-2. Jaime asks,
to be honest, I think we're serving slightly different use cases as well. Yeah. Like if you're trying to build a firm and go fund 1, fund 2, fund 3, I think we are the platform of choice for you. If you're doing syndicate investing and you're not sure whether or not you want to build a fund, et cetera, like I think different options for different folks.
Yep. And Jaime, Peter said at the beginning that we'll probably have more data on LATAM end of this year, maybe beginning next year. Hopefully,
I hope. Yes, at least on the cap table side, I think we're going to start doing some LATAM reporting. Fund side is much harder. That is a much smaller population for us. But yeah, Jaime, keep bugging me about it, but don't hold me to it. Don't be too disappointed if I fail you here.
and Jorge has some other questions as well about like what's the average check size in a $1 to $10 million fund?
Yeah, so this is just anchor check, right? So it's just the biggest check into those funds. 1 to 10, the anchor is probably going to take between 20 to 25% of the fund in general, and then you kind of fill it out with smaller tickets. That would be so an average ticket around 500K, but an anchor north of, call it 2 million or so, I think is pretty reasonable. There are the fund LP counts. I think the strategies there are pretty widely varied as well. So is it going to be the case that you want to collect, same thing with founders here, like do you want to collect a bunch of small ticket checks and manage a much larger pool of LPs, or is it more useful to you to stay focused on higher level checks where you manage fewer LP relationships? I've heard both, honestly, but I don't know exactly where the market is headed on that.
Cool.
Okay, let's get to the fun or not so fun stuff.
Dun dun dun.
I'm gonna clip that and put it on all of my presentations. Yeah, that's good. It's really nice. Okay, performance by year. So this is net IRR, so net of fees and carry across all the funds that we spoke about. So all 2,000 funds in each one of these vintage years. Obviously, the older vintages are better performing because they have had more time to mature. So that is expected. However, if you look at 2021, already kind of lagging behind even younger vintages in some cases. I really think that a lot of what the performance metrics say here is, one, performance is struggling a little bit across the board, but two, this is just a reinforcement of how crucial vintage year diversification actually is. There will be good vintages and bad vintages, and selecting them in the moment is very difficult. So for the funds who were begun in 2020 and then invested 80% plus of their capital to invest in 21 in that frenzied market, outperformance is going to be very difficult because there's just not enough time dilation there to have chosen the right companies.
And so to expand on that, Peter, in terms of time diversification, so if I'm a fund manager or an LP, it makes a lot more sense to make measured investments on a year-by-year basis into different funds, and as a VC, make measured investments over multiple years, and not get carried away and splurge and write a whole bunch of checks one year and none the next. Is that
exactly? Or too scared on the other end and say, "Oh my gosh, things are going to hell. I won't do any investing this year," which we saw deployment pace rapidly decline from 21 to 22. Yes, like consistent investment across time periods, I think, is almost certainly the right way to go. Now, of course, VCs can have reasonable pushback there and say, "Look, I'm just investing based on the quality of the founder that I encounter, and I'm not trying to, I might meet someone tomorrow who's the perfect person, even though I made a deal last week." I get that. That's totally fair. But on an aggregate basis, investing too much of the fund in a single year, it's what it does is just increases the variance. Either you're going to be really right or really wrong. And being wrong in 2021 was a lot easier than being right, even though it didn't feel that way. Yep. So if you take a look, so this is not median IRR, this is top quartile IRR. So top 25% of funds for each one of these vintage years. And the clearest part, so the reason that we build these charts this way is because it allows you to compare vintage years against one another on similar paths. So the x-axis in this case is quarters since the vintage began. So you can see the curves of these charts, and you can really measure, hey, at 8 quarters, how do these vintages do against one another? But again, the pattern's incredibly clear. Shooting up, really big IRR changes for 21. Everyone was excited, a lot of markups, etc. And then gradual declines here or in some cases, fairly steep declines as down rounds have happened, as valuations are, IRR, because it takes into account the time value of money. The staler a mark is, the worse it is on an IRR basis, whereas a TVPI, it just kind of stays flat. But stale marks are not good for IRRs in this. So we see a lot of fund managers using this kind of data to go back to their LPs and say, look, we're actually doing pretty well, even though the absolute numbers might not be exciting to you right now. And there's time for this to get better. It's going to be hard. And you can see some of the traditional J curves in venture still exist. We'll run through these charts, I think, a little quicker. Same thing for TVPI. You've got 90th percentile TVPI looking pretty good so far for 2017, et cetera. It's tough. One of the things, I don't know, Jonathan, if you have any opinions on this. One of the things that I get kind of frustrated with is when people take this data and then lay over like what the S&P did over the last 7 years and say, everyone who invests in venture is an idiot, just invest into the S&P or the NASDAQ. Like, those are fundamentally different products serving different needs. And yes, the median venture fund is going to underperform public markets like all the time. You should expect that. I don't understand why that would be like a case against venture. If you're investing into the median startup or the median venture fund, it's not a good investment. You're looking for the outliers in everything.
Yeah. And as I was kind of learning about this industry, I was always like, well, what is the industry performance of venture as compared to like an S&P 500 benchmark? Yep. And that's just the wrong question to ask. Yes. Because some funds have, a decacorn year 10 and they IPO, and that's amazing. Yep. And some funds year 15, and then that's when you actually realize that value. And so yep. S&P, I was looking at S&P futures last night after the tariff announcements. I'm like, oh my gosh, they're down like 3% in 3 hours. Right. And so it's a much different time scale. Like venture performance, you measure in like decades and vintage years, as opposed to S&P, where it's like minute by minute, day by day, month by month sort of stuff.
100%. And we've had like a historic run on the public side over the last few years. Look, if the question is, should I put $1 into NVIDIA versus $1 into venture? For most investors, the answer is obvious. Don't invest in venture. But that's not what the like part of these portfolio constructions are about. These, an LP with a well-diversified portfolio is putting 5 to 10% of their allocation into venture. That makes sense. If you are good at manager selection and you think you can get an outlier return, that is changing the alpha of your investment strategy. But it is not to say that every dollar invested into any company should go to venture versus the public markets. Like that's just not the right way to think about it.
Yeah.
So TVPI over time, this is the same chart as IRR, except for because total value doesn't go down over time, you just kind of get this more flattening of the curve, no longer boosting up. Of course, the full report has top decile and you can kind of mark your own fund where it is. And then we get to the big stuff. Oh, wait, one last thing beforehand. A fun question we always get is, do smaller funds perform better than larger funds? In general, I think the way to answer that question is smaller funds will be more highly represented at the upper bounds of performance. Yes. In some ways, that's just math. It's easier to get to a 4x on 10 million than to get to a 4x on 500. But the skew is wider at the early part. So there's a lot of very poorly performing small funds as well. In fact, there are so many more small funds that getting a poor performer is maybe more likely in small funds because you just have to select from so many managers. So, but outperformance, the data is, I think, pretty clear. Outperformance is more possible at smaller fund sizes. And, you can look on the right side of this table, that's 90th percentile TVPI. The smaller funds have higher 90th percentile TVPIs than the larger funds. But that does not mean it is like part and parcel. Okay, then everyone should just invest in the smaller funds because it's easy. It's not how it works. Yeah.
Yep.
But for the small fund managers out there, you do have the chance for outperformance in a way that I think is the case that you should be making to LPs against larger fund commitment sizes.
And do you have any data on emerging managers versus established managers, their fund performance, or no?
Yeah, I mean, I would imagine that if you just break this out by the fund size, you can kind of net it out that way. Everyone has kind of a little bit of a different definition of what it is an emerging manager. I guess the one we use internally is fund 1 through 3 if they're under 100 million AUM or committed capital. But some people might quibble with that. Okay. So we just broke it out by fund size because it's, I think, a little more concrete. I do want to do an exploration in the next report of fund ones only, which I think will be interesting. And then, of course, the big question we get is, can you do anything about solo GPs versus non-solo GPs and things like that? So more slices on this data, I hope, coming soon. And then we get to the last one, the big question. Recycled. Don't preview the data that way.
Sorry, man. Sorry.
You're just giving away the shot here. But yes, DPI. Distributions. Why we're all in this business. Okay. So again, we illustrated this by vintage year. It basically from 2021 onward, no DPI, and that is to be expected. DPI in the first 3 years, either something went incredibly right or maybe wrong for that to happen. It is not expected. Now, once you get into 2017 is 7 to 8 years old now, then you start to see at the outperformance, fairly significant DPI. The 90th percentile for DPI for 7-year venture fund in 2017 is 1.42x, meaning the investors in that have already made back their money plus some, and there's probably a lot more performance to go for those high performers. So this can work, but it is a long-term game. And if you want to look at just the simplest view of this, which is what percentage of funds by year have given at least $1 back to LPs, you can see that for recent vintages, it's lower on a percentage basis than it is for higher vintages. But even for the high ones, call it after 4 years, only half of venture funds have given $1 back to LPs. So again, these charts are, into my mind, just an illustration of how long this takes. And the push for early DPI, I think in many cases is a poor one. Although I do believe that secondaries and early M&A are going to be bigger parts of this market moving forward. Fundamentally, the promise of venture is you kind of have to ride those winners in many cases. So you have to be willing to eat the illiquidity for a long time to get to the really high levels of outperformance. If you're shooting for a 3X fund and you just want to do that a lot, I think secondaries, taking money off the table, like more strategies like that make a ton of sense.
And Christian had a question. There's a lot of noise around that venture capital is on the verge of disruption as an industry. Based on the type of data that you were seeing, are you thinking that VC is going to change, that it's going to have to change size, returns wise? Any crystal ball?
This is the this is the $1 trillion question, honestly, Christian. Like, it's it's one that I think that we think about all the time internally. So I guess there are two paths of thinking here. One is there's too much money in venture capital. Mega funds are playing different games than small funds. And because of that, returns will be competed away by an excess of capital as they have been in other asset classes. I think that is a fairly reasonable picture of the world. The other way to think about it is, well, actually, because of the way that companies are being built with maybe a lot less capital needs, et cetera, there's going to be a stratification of venture investment strategies that really benefit both really big and really small players. But the middle will kind of be hollowed out. So, and both of those paths have a ton of data supporting them right now. I don't think there's a clear answer to what is right. I would be kind of stunned if VC was doing exactly what it's doing now in 5 years. I think something is going to change. One of the biggest ones is just those mega funds have gotten gigantic. And they're willing to play across all stages. And, some emerging managers, I think, rightly point out, well, you can't get a 10X on a Andreessen fund anymore. It's just not possible. I got to be honest, that's not why the LP is investing in Andreessen. They know that. They're not going, they don't expect a 10X or a 5X from those. They expect conservation of capital and then a lot of other perhaps non-return reasons why you might invest into Andreessen. So the games are getting more diverse.
And if you also look 5 or 10 years ago, even like 7 or 8 years ago, AngelList was making huge waves. Yep. And now, just like the AngelList syndicates, and now they've kind of morphed into a bit of a, yes, they still have syndicates, but they're a fund management platform.
Yep.
Like the big thing when I came into town in 2010 was, super angels and micro VC funds.
Yep.
Like a sub $100 million VC fund was a huge thing. And now you have 1,500 of them.
Yep.
And so the industry changes a ton from year to year.
Yeah. And there's a part of me that, so there are two words, or there's one word that I really don't like that people keep throwing around in venture capital, which is the word tourist. It's like, oh, they're just tourist VCs or they're tourist founders, meaning they did this because it looked cool. But yes, do those people exist? Sure. But are the people that fail all tourists? No. A lot of them were trying real businesses or trying to be great VCs and they just didn't work. I don't know what the instinct is to just like downplay other people's stuff when you don't know what their motivation was. But I do think that there will be meaningfully, like, Josh Wolf at Lux Capital has this prediction that there's going to be 30 to 40% fewer VCs in 3 years. I think that's probably, that's aggressive, but I don't think directionally it's wrong. I think there are a bunch of VC funds who got started in the last few years who this will be their only fund. And that's obviously tricky for founders to navigate as well if you're not sure if a fund manager is going to be around to support you in 10 years.
And I think the hard thing from the entrepreneur side is VCs aren't really public about that information.
True. Yes.
And no, I what you call, taking umbrage to people calling some VCs tourists, I still remember the person at a Hackers and Founders event that called me a wantrepreneur 14 years ago.
Right.
I'm still in the game, and dude's been CTO of senior engineer at Big Co's for a long time. So
I'm glad you keep tracking. Now you got to keep that chip on that shoulder, Yeah.
I know, right? It just keeps on coming back. It's the PTSD of the whole thing.
Yeah.
Juan said, do you have any info on capital calls that aren't making it through? Are LPs getting skittish?
Yeah, so this is what we would call a default on a capital call. Really, it's a really interesting question. So we did see that percentage rise a little bit over the last few years. It hasn't exploded. And then you might wonder, it's okay, if you have a contractual agreement with an LP and you're a fund manager and they don't fulfill their contractual agreement, why wouldn't you be vocal about that? Well, it comes back to the relationship of venture. That might be burning your bridge to a lot of other capital. Venture is it pretends to be big business and finance, but it is at the heart of it very, very, very small and relationship driven in many cases. And so this is, again, why some founders just kind of take bad behavior from VCs, or the same with GPs to LPs or whatever. It's because they don't want to burn bridges. And so we have seen some capital call defaults increase, but again, it's not like a meaningfully large percentage. I don't think that's happening too much. And then there was also the second prediction, which was, well, some VCs are just going to return LP capital and say, look, we just don't think that we will be an outperformer in this market. We haven't seen much of that either. So people are continuing along their tracks and sort of letting the chips fall where they may.
Yeah, and fund managers are essentially entrepreneurs as well. It's just it's a fund management business as opposed to a startup business.
Yes.
And it's really hard for a founder to just kind of walk away and say, nope, I'm done. This isn't gonna outperform. It's always blood, sweat, and tears. I'm gonna keep pushing this.
Yep. Well said.
We probably have about 2 more questions if anybody has any. Peter, if you had a magic wand, what would you change about the industry in the next couple of years?
I'm giving that some real thought because I think it's a very good question.
Appreciate it.
I think what I would change would be 2 things. The first is I would try to increase the both availability and decrease the cultural stigma of secondary activity in the earlier stages. So, this is changing, but to me, I think one of the problems with venture is that it is, by its current construction, a power law asset class to an almost absurd degree. Whereas I do think that there are interim models where you have pre-seed funds that then take the money off the table at the A or the B and return cycle capital a little bit more quickly. And I know some people are doing it, but it's not by and large a thing that happens. I think there's more availability to sort of take money out of these growing businesses as they grow and recycle it back to the earliest stages. So that's one. The second is, and this is, if VCs are good at one thing, it is marketing themselves and their asset class and this way of company building. I do think that just making sure founders understand that venture is not the only way to build a business, and that also venture can be available to you after you do something else. So maybe you start this as a bootstrap company, you grow pretty significantly, and then 5 years down the road, you interact with VCs instead of doing it up front. I think that VC is a wonderful capital source, but it doesn't have to be as rigid as it is today. So I would try to diversify when and how people interact with the venture capital ecosystem. I don't even think Imagine Quand could take away the mega fund problem and all that kind of stuff. So I'm not going to touch it.
Yeah. No, and I've been doing a lot of talking with, for instance, different stock exchanges who are, like the London Stock Exchange has a fantastic IPO product for companies in like the $300 million to $2 billion range.
Yep.
Like 20 years ago, we had that in Silicon Valley. This is what, NVIDIA listed at what, a $300 million valuation. Can you imagine buying that IPO?
Right.
But, people keep on asking me like, well, why haven't I heard about it? And I'm like, well, venture has a couple $1 trillion in AUM that pays for a lot of PR, man.
Certainly does.
And you have one stock exchange.
Yeah.
Like competing against that. And so I would love to have more different varieties of different funds and different types of capital available for founders. I love that.
I also think that you've touched on a really important point, which is someone needs to make the bull case for going public.
Yeah.
I think that in this environment, there's not enough folks who are trying to actively make the case that not only is going public something that you want eventually, but it is actually good for your business. And I do think that that's kind of lack, at least here in the States. It effectively feels like IPOs are this, okay, we'll do it. But for the best companies, it's something that they're kind of actively avoiding. And that isn't good for recycled capital. It's not good for retail investors, et cetera. So the more, and I don't know whether or not that bull case needs to change, but I do think that it needs to be more vociferously explained to a lot of people.
Yeah, and I had a couple of conversations recently with the Long-Term Stock Exchange and Eric Ries, and I think we'll probably do one of our next conversations with them.
Great.
Their argument is that the current U.S. stock markets are basically optimized for hedge funds who get paid every quarter, and so it's about quarterly returns. They get optimized for high-frequency traders, and they also get optimized for fees from the huge banks, the huge lawyers, and the huge accounting firms.
Yep.
So everybody's incentives are bigger, wait until later.
Yeah.
Whereas that's not really in the founder or the company's best interests. It's not in the best interests of the early shareholders, and it's not interest in the retail investors. But, it's a $25 trillion asset class. So are you going to argue with that? Right. Christian said, based on the last comment, the magic wand one, should there be a third option other than M&A and IPO?
I mean, there is. Secondary tender offers have been exploding in popularity. I think actually getting a little bit more headlines than they potentially deserve, only because they're restricted in some cases to the very cream of the crop. So if you are Stripe or SpaceX, you have unlimited private demand. You can get your employees liquidity on a regular basis in the private markets. You do not need to IPO for that reason. You can make bull cases and other reasons. That status does not apply to most private companies. If I listed the majority of private company stock on a stock exchange and people could buy or sell it, I think you'd be shocked at how little demand most of those companies have, because they're, tiny businesses and it's not clear whether or not they're going to work. So I think it's not an every company place, but I do think secondaries are an interesting part of the market that's here to stay. And I think there'll be more creative uses of them moving forward, especially if a company is going to stay private 15 years.
And having recently spun out of a secondaries fund at Practical VC, they kept on saying that the VC market is probably 5 or 10 years behind the private equity market, where in private equity, you actually have like buyout funds, like they will just go and buy out other funds.
Yep.
Or there's secondary VC funds, or there's VC funds that will take one whole LP position, or there's a lot more variety in the private equity world. And I think that will probably have to happen in VC as well.
Yeah.
Jorge also asked, for emerging fund managers, what do you think is the main reason LP says yes in you when they believe that there is why do LPs say yes?
We ask a lot of LPs this, and they give us diversity of answers. But really, it comes down to a couple things. So I think you can separate this out between Fund 1 and every other fund. So if you are Fund 1, it is a bet on you. It's effectively the same thing as a founder. It's a bet on you. Where did you come from? What is the experience? And then the most crucial thing, what can you do to prove to me that you have the right to win with the right founders? What is your right to win? How can you source and close, not just source, but actually win those deals? And this is an interesting thing we're going to see right now in a creative way. We're seeing a lot of GPs spin out from really big funds and start their own thing. I think the thesis there is I have this institutional background, but I think I can win with founders, et cetera. And we're going to see very quickly which of them depended on the brand of that big fund and which of them go and win themselves. But that is always the case. How do you win yourself? And then the second, when we get to that second category, which is fund 2 and beyond. So this is potentially the question, Jorge, of why would an LP fund continue to commit capital to a manager that they've already worked with? The line that we always hear, and I know it's frustrating for GPs, is, did you do what you said you were going to do? And some of that is easy, right? Some of that is, we invested into you because you are a biotech fund, but half of your portfolio is an AI enterprise. Even if you're kind of right, it's not what that was not what we asked you to do. We have probably enterprise AI funds. We wanted a slice of biotech. So you not doing what you said you were going to do, it's tough for us, even if you're making the case in some cases that you're right about the company choice. It's not why we invested into you.
Yep.
The other thing is ticket size. Like, did you have a theory of the world that ended up proving true? I could win the deals at the check sizes that I thought I was going to win the deals with the right founders. I was seeing the right access points. All of that is going to be evaluated by LPs. I do think that while the fund performance data that we put up is useful, good LPs understand that in the first 3 years of a fund, those data are barely directional at best. You can go from best to worst or worst to best pretty quickly in this business. So it's much more about, did you prove to me that you're going to do what you said you were going to do and that you have the right to win with the right founders?
Interesting. Juan Ignacio asked, basically, I think the question is, have you seen an increase in the number of new LPs from other countries? One of the challenges that we have in Latin America is that a lot of wealthy families don't have family offices, and it's kind of a new thing. And so they're not used to diversifying their assets into alternatives and into venture. Totally. And so it's hard for them to invest into a VC fund.
Yep.
Are you seeing like the geographic distribution of those LPs? Where are you seeing it?
We're actually seeing the opposite, a bit of a retraction
really
from other countries, which is a shame. I think this is it's mirrored in the problem with, pre-seed markets for founders, which gets back to the core point. What do rich people do with their money? In Silicon Valley, they invested into startups. Maybe because they want to, maybe because they want something to say at the dinner party, right? Like, there's a lot of cultural reasons why you would be invested into startups as well if you live here. But in Dallas, if I made my money in real estate or oil and gas, maybe I give it to startups, but maybe I do something else with it. And there's a lot of choices. I think that same thing is true for LPs, like introducing LPs into the venture asset class. I do think that there are roles for people whose sole focus is to introduce new LPs into this asset class. One, because I think it's useful, but two, because I think like educating LPs is an underrated part of the GP's job. Especially if you're not talking to institutions who've been here for a while. So there's a hole in that market. And it's super opaque and hard to get a hold of. And like, there's probably a list of 1 million, literally, family offices that you could talk to. So how do you pick and choose? It's not an easy problem. But I do think that, again, someone to make that bull case to LPs, new LPs, it would be an amazing, useful role in the ecosystem. And I'm sure it's harder in LATAM than it is in the US.
No, that's actually a really interesting point. The last question, and this is probably a little self-serving as well. Christian Guardia says, so is that a case for small IPOs? If so, what scenarios are out there? Like, what would the argument that you would make to a GP for you should have your companies consider an earlier IPO if the exchange is right, if it's a right market, that sort of stuff? Like, don't screw your companies over. But what would the argument in terms of fund performance be for GPs having smaller, earlier IPOs?
I mean, the obvious argument is like quicker recycling of capital, lower amounts probably, but more recycling of capital immediately. And then it's a question, I think, which is a worthy one that LPs should raise with their founders, which is like, does this introduce discipline into this business that is necessary? And the other route, if you're really thinking about this and you're saying, okay, we're a $300 million valuation business, $400 million valuation business, something like that. What are our options? We don't think we're going to get to pure venture scale. We could small cap IPO. We could start talking to PE firms and that kind of thing. But the advantage of the small cap IPO in my mind is you're not selling, you still are the leader of that business, right? When you go to PE, that's a majority stakeholder most of the time. That's a tough one. So you're kind of not giving up the dream, but that is in one way a major milestone.
Yep.
I do think that there's a bull case to be made for small cap IPOs. Again, some of this is just cultural. Like that isn't what the founder has been told at all during their journey. They have, especially here in Silicon Valley, it is be as ambitious as you possibly can be. Anything under $1 trillion is a failure. And I don't love that super grind heavy, only one outcome is good thinking. So maybe this is the big theme of this talk is we need better storytellers for the alternative paths through venture. And that I think that like having those voices be more prominent in the ecosystem would be a net good to entrepreneurs.
And one of the reasons why I started on this path was when I came to Silicon Valley, I started a Hackers and Founders meetup.
Yep.
And after thousands of conversations with founders about what a pain in the ass it is to raise money, I'm like, why is this?
Yep.
And some founders absolutely shoot for being a decacorn.
Yep.
But if you want to build a company that's doing 20, 30, 50, $100 million year over year, growing 30%, 50% year over year, like that's a great stock.
Yes. Yes.
That like I will buy as a retail investor, if that stock is on the stock market, I will buy that every day of the week. As a VC, I cannot touch that stock.
Yep.
Because that's not how my business model works as a VC.
Exactly. So like more diverse paths through the capital landscape and ultimately out into recycling this capital back to LPs. Like we're all for it. We need some, I think we've hit a trough of new ideas. Let's build some new ideas, not just for entrepreneurs, but also on the capital side.
Peter, thank you so much, man. Every time I talk to you, it's like, I'm in the Matrix and I have learned Kung Fu. So thank you, sir. Really appreciate it. Thank you to our audience. Thank you for the questions. And thank you guys so much. Have a great day.
Yeah. Until next time. Appreciate it, y'all.
Cheers.